Hey, it's Patrick Moore with Ironclad Wealth Management here, and I've got the final video in our Ultimate Guide to Saving Taxes on the Sale of Your Business series. And this is the most flexible, by far, strategy that we've discussed yet. And it is tax loss harvesting, which is something you can do if you don't have a business. This is something that when you combine it with a business sale, you can really make some magic happen. And on top of it, there's no crazy lockup periods. You don't have to do it 5 years before anything else. It's something that can really, really make a big difference if you're trying to find some ways to save some money on the sale of your business. So, before we get into everything, as always, this is general tax information. You definitely should take it to your individual tax advisor or schedule a call just to make sure that you're doing this the right way and not missing anything. Now, having said that, why might you need a tax loss harvesting strategy when you are getting ready to sell your business? Well, it works for everyone, but the people who might really, really need it are those who got an offer come out of the blue. The sale closed quickly. Maybe you're already watching this video and you've got a signed LOI. There are strategies out there that require 3, 5 years of pre planning to make the most of, and you don't have that. And on top of that, you still want to save money on taxes because you're just like everyone else. If that's you, tax loss harvesting is a potential solution. So, what is tax loss harvesting? Well, it's a fairly simple concept that is very complicated in execution. All it means is that you're selling investments that you hold at a loss and you're booking a loss. But if you think about your tax return, if you own Apple and you bought it at $200 and you sold it $150, you would have a $50 loss. Well, on your tax return, if you have capital gains from the sale of your business, that $50 loss can offset your $50 gain from the sale of your business. So you can book the loss and still maintain your investment outlook because when you sell that Apple, you usually turn around and buy something very similar as long as it's not identical. So, how does that work? Well, the main rule that you need to know about tax loss harvesting to count and make it work is the wash sale rule. It states that you can't repurchase a substantially identical security 30 days before, the day of the sale, and 30 days after your sale. If you do, you can't use that loss on your tax return, which kind of defeats the purpose. Now, a lot of times people say, hey, we're just doing this, we're still losing money. And that's true in a sense, but when you're doing it a particular way, that's not quite the case. So let's give you a few examples. Apple's $200, it's now $175. If you sell Apple, you'll book a $25 loss, and then you don't want that money sitting in cash. Well, you can go and buy QQQ, which includes Apple, for $175 and keep your loss and maintain your same tech exposure. So what you're doing is, yeah, you've lost money in the short term, but long term, you've got a similar position that's not identical, still performing. So you're just kind of taking advantage of short term market fluctuations to get permanent tax savings. So, how do you convert that into a system that actually can create substantial enough losses that are really not something you're feeling in your wallet to offset your tax sale, your business sale? Well, that's when you turn into a systematic tax loss harvester. And what that means is when you're thinking about investing your money, if you want to invest in the S&P 500, you can buy an S&P 500 ETF. Or you can buy 300 stocks that are in that 500 position ETF that recreate the same type of investment performance over the long term. When the S&P 500 is up 10%, most of the time, in fact, I would say probably every year, but I'm not 100% sure, most of the time, the way that that works is of those 500 stocks, 100 of them may be at a loss. And so what happens is if you're just in the S&P 500 ETF, you're up 10%. There's nothing you can sell. What a systematic tax loss harvester does is they go in and they sell those ones that are at a loss, those 100 at a loss. They're still up 10%. They get to book a tax loss and then they rebuy similar positions. Those similar positions kind of keep them in the same risk sphere. They keep them in the same expected returns projections, and it allows you to track the index while generating tax losses. So when I say that you're not losing anything, These systematic tax loss harvesters that do it well, they are so close to the index that there's really a negligible difference in returns. So, how does it help you after a sale? Well, as I said earlier on your tax return, the capital losses from the tax loss harvesting account offset the capital gains from your business sale. One thing you can do is if you're ready to sell a couple years before, you can go in and do this a year or two before and really build up a bank of losses if you'd like. But also, you can just do it after the sale. So this is something that can, when you combine with the sale of your business, can really create some extraordinary results. Now, keep in mind, if your business has depreciation recapture, accounts receivable, inventory, and you're doing an asset sale, those ordinary income items can't be offset by capital gains. It's like oil and water. Capital losses can only offset capital gains, other than like a very small limit. So let's look at our case study here. So we've got a Georgia-based engineering firm. We've been with the Daniels throughout this video series. They're selling for $10 million, and they got a taxable gain of 9.5. They are doing a stock sale. Well, if we look at the left-hand side, if we look at that, they are going to pay on that $9.5 million about $2.35 million in taxes, which, that's about 25% of what they're looking to make. If we implement a tax loss harvesting strategy, and there are some sophisticated, systematic tax loss harvesting strategies that can generate about 32% in losses that first year. If you take that $10 million of proceeds, they came to me, they're like, hey, we got an LOI, what can we do? We'll put it in this strategy. It can generate $3.2 million of losses while kind of matching the market. If they do that, it'll lower their net gain to $6.3 million, lower their total taxes by $800,000 in this scenario, and it just means that they have $800,000 more in their pocket than they would have otherwise had, which takes their kind of effective tax rate, including the basis, from 23.5% down to about 15.4%. So when I'm talking about getting great results, this is something you can do with little to no pre-planning. If you have a sale and you're trying to get it done, it's something you can do. Now, having said that, while you can do it before a sale, timing always matters, and it still matters in this case. Because the way these programs work, they sell throughout the year. As the market goes up, they'll sell. As the market goes down, they'll sell. Well, if you sell in December, they've only gotten 1 month to generate losses. And typically, the market fluctuates all throughout the year. So it's the best way to do this is to have this program set up in January. If you do it mid-year, you'll still get some benefits, but it won't be as good. And if you wait until December, you'll have limited effectiveness because they need to capture those fluctuations throughout the year. If you're just in December, that's 1 month of losses. You won't get those projections I was showing you just a minute ago. So it's something that it matters for everyone. It's all different, and you don't have to do it before your sale, but you do need to be cognizant of when you do sell and how you can get the most of it. And like I said earlier, if you have cash outside of the business, you can also do this the year or two before you sell the business and carry over those losses into your tax year that you do sell the business. So what setup requirements are there? Well, to do this well and to kind of systematize this, you do need what I would call an automated third-party manager. There's lots of groups out here that do this. Unfortunately, they do have account minimums, so you really can't do it with just a few bucks. You do need to have $100,000, $1 million plus dollars, depending on kind of what strategy you're using. The wash sale rules apply, as we discussed. But these automated third-party managers incorporate all those rules into this. And when you deposit their money with your money with them, they'll send you reports on exactly how much in losses have been generated, and then you don't have to worry about it. You just need to make sure that they're kind of doing their job, doing what they need to, giving you the returns you're expecting, and achieving some losses along the way. So what are the risks and drawbacks? Well, I think the biggest risk is that you are investing in the market. So if the market goes down, you'll be down. If the market goes up, you'll be up. It is market dependent, and it will fluctuate just like you're investing in another investment account. As I said earlier, they are less effective with late year sales. Not that you have to invest before you sell your business, but if you do it in December, you're just not going to see that much from it. There's an uncertain outcome until you're in, because it is purely based on what that market does. Nobody's going to know exactly what the market does. So there is an element of you're kind of not sure exactly what this is going to do until the end of the year. And then finally, because this is generating a lot of losses, you're kind of deferring your taxes into the future. If you turn around and change your mind, which you can because this is the most flexible type of project with no lockup period, you can sell at any time. You might just owe some of the taxes you were going to pay beforehand when you do that. So who's this best for? Well, I think it's best for sellers with little time to plan. And I think it's sellers who are wary of like an investment with a lockup period. A lot of the other strategies we discussed, they use words like irrevocable. You got to hold for 3 years, 5 years, 10 years. This is not one of those. So if you're wary of stuff like that, I think this is a good solution for you, whether or not you're planning 3 years before or right as your sale is going through. So what do we do to help? Well, this has been a 9-episode series, 7 of which are dedicated to specific strategies. We look at all of the strategies from your side of the table, help you figure out which one is best, and then model them for you so you can decide that that's the case too, or say, hey, Patrick, I don't really like that one. Not only that, we coordinate with your CPA and we combine this with other strategies for your tax savings because this may make sense, but it may make sense to combine it with others. So that's what we do. That's what we look at. If that sounds like something you'd be interested in, feel free to click this link here. We do about a 15-minute intro call just to make sure we're not wasting each other's time and that we can actually help. If you do want to get that done, we're happy to help at any time. And we also have 8 other blogs and videos. So if this strategy doesn't sound that interesting to you, there are other ones for you to take a look at. So I hope this really helped. I hope you found this interesting. And if you have any questions, just give me a call and I will talk to you later. All right, bye-bye.